So over the past few weeks, the stock market has been plummeting and everyone has been talking about it. But why is this important? If you're just an average working person who's not an investor, who doesn't invest in the stock market, you work a 9-to-5 job and collect your paycheck every 2 weeks, should you care? Well, maybe you should, because a stock market crash could affect you more than you may know. And I'm going to explain how, why, and just what you can do to take advantage, even if you're not an investor. But before I do, what exactly does it mean when stock prices are dropping? So for those who don't know, the stock market is a place where investors buy and sell shares, which represents ownership of publicly traded companies, which allows companies to raise capital and investors to potentially profit from the company's performance. So how does it work? A company that wants to raise money can go public and sell shares of their company to investors, and investors can then buy and sell those shares from each other on the stock market, potentially selling them for more than what they paid for them. The price, just like everything else in this world, is determined by supply and demand. And since supply and demand is constantly changing, stock prices are constantly fluctuating based on how many people want to buy it and how many people are willing to sell it. Now, when stock prices start dropping, not a particular stock, but all across the board, it may be hard to pinpoint an exact reason, or it may be caused by a number of reasons. An uncertain economy, pessimistic investors, political and international feuds. I mean, it can be anything, but it's important to understand that stocks dropping can just be a temporary thing that will eventually correct itself, or it can be a signal of economic trouble ahead. But how exactly do you know? Well, to get a good feel on how serious it is when the stock market starts dropping, you have to look at the percentage of the drop. Now, if stocks drop more than 10% but less than 20% of their recent high, this is known as a correction. Now, corrections are common, on average happening every 14 months since 1980. But as of late, they've been a lot more common. Get this, we've had 5 corrections in 2020, 4 in 2022, and 1 in 2023. With corrections, the fall is usually a lot more gradual, typically taking about 5 months to reach the bottom of the correction. And it also can recover fairly fast, taking about 4 months to rebound. Now, if stocks drop at least 20% from a recent high over a gradual period of time, this is known as a bear market. During a bear market, investors are usually a lot more pessimistic, which leads to a widespread desire to sell. And if the desire to sell is up, but the demand isn't, it leads to prices dropping. Bear markets can last months or even years, and usually occurs just before or after the economy moves into a recession, but not always. There's been 27 bear markets since 1928, but only 15 recessions during those times. And then you have a market crash, which, like corrections in bear markets, are drops of 10 to 20% plus, but these drops are sudden, quick, and usually unexpected. Corrections in bear markets are a lot more gradual and spread out, while crashes are immediate, happening in a day or two. This has only happened a handful of times, most notably October 29th, 1929, which is referred to as Black Tuesday, where over the span of that Monday and Tuesday, stocks dropped 25%. October 19th, 1987, which is referred to as Black Monday, where they fell nearly 23%, and March 16th, 2020, the COVID crash, where they dropped nearly 13%. Now back to 2025. So far this year, since Trump has taken office, US stocks have underperformed global markets. This week alone, stocks have lost $4 trillion in value. So where are we as it pertains to the percentage in the drop? Well, as of yesterday, we've officially hit correction territory, as we've experienced a 10.1% drop, which has a lot of investors worried about the unknown future of our economy. But why are stocks steadily falling, and why now? Now, it's hard to pinpoint an exact reason, but many believe it has to do with Trump and these damn tariffs, as he's constantly threatening to impose tariffs on other countries, and they retaliate by threatening us with tariffs of their own. As volatile as the stock market is, we see it reacting in real time to what's going on with our government. People are confused and filled with uncertainty on the future of Trump's tariff policies, and a looming government shutdown isn't making matters any better. But like I said, corrections are a lot more common than bear markets and crashes, and just because we've officially hit a correction doesn't mean we'll enter into a bear market or recession. So at this point, all we can do is wait. But exactly what type of impact does stocks dropping have on the economy? Well, you may be thinking, I'm not an investor. I don't buy stocks. So what does this have to do with me? Well, it may affect you more than you may know. For one, if you're a W-2 employee and you get your paycheck every 2 weeks and automatically money is deposited into your retirement account, such as a 401k or a pension, many of those accounts are invested by the company that you work for in the stock market. So the performance of the market can directly impact the financial security of your retirement. A lot of times when we make these deposits, we're not really thinking about them because we don't physically deposit the money into the account. I know I didn't back when I had a federal job, but keep working long enough and those consistent deposits add up. And you may not even realize how the money is going up or down unless you constantly check your balance. And another way it can affect you. When stock prices are high, there's typically an increase in consumer spending, which increases the demand for goods and services, which in turn increases prices. And on the flip side of that, when the stock market declines, it can cause consumers to reduce their spending due to concerns about their financial security. This can lead to a slowdown in the economy. Lower demand lowers prices. The amount of consumer spending ultimately affects pricings for goods and services, which affects everyone in the economy. And if we just so happen to slip into a recession, then we'd be opening up a whole nother can of worms. But like I said, just because the market hits a correction or a bear market doesn't mean we'll automatically head into a recession. Stocks are very reactionary, unlike real estate, which takes a lot more time to react. You're not going to see a widespread value of homes drop instantly in one day, like stocks do in a crash. But with that being said, how exactly would a recession affect the housing market? Well, historically, recessions have led to a decrease in demand for housing. And when the supply increases and the demand decreases, homes start sitting on the market a lot longer, which results to home prices eventually dropping. But it ultimately depends on the type of recession we would be in. Would it be short-lived, like the one in 2020, which led to a rapid rebound in home sales and prices? Or would it be prolonged, like the 2008 Great Recession, which lasted years and resulted in a slow recovery and significant price declines? And how exactly would mortgage rates be affected? Usually in response to a recession, the Federal Reserve will implement policies to help balance out the economy. And this typically means lowering interest rates. By lowering interest rates, it can cost a lot less to borrow money, which incentivizes home buyers to purchase. For instance, a $600,000 house with 20% down and a 30-year fixed rate loan at 7% would require a monthly payment of $4,214. However, if the interest rate is lowered just by 2%, from 7 down to 5%, and the payment now drops $616 down to $3,598 a month. The increased purchasing power by having lower interest rates creates an opportunity to possibly purchase higher priced homes that any other time home buyers may not have been able to afford. And lower rates would also give current homeowners the option to possibly refinance and secure more favorable terms of their loan. So again, whether you're a stock investor or not, the stock market crashing, which may lead to a recession, can definitely have an impact on your life. Usually during these times, the savvy investors make their most money when interest rates drop and the cost to borrow money is much cheaper.
So just before 2008, the great financial crisis, when the whole thing came crashing down, I think I borrowed over $100 million to go and buy the best real estate around because it was on sale.
And even if you aren't an investor, those of us who are in a position to qualify for financing, this is a time you can usually get a good deal. I purchased my very first property at the tail end of the Great Recession, and I made over $100,000 without even trying, completely by accident. Those are the type of opportunities that can possibly be taken advantage of in a recession. But again, let's not get ahead of ourselves. We're not in a recession just yet. And as of now, we hit a correction. We shall see what the future holds. As always, thanks for watching.